Just a standard risk disclosure before today's video. I'm not a financial advisor or trading expert. I'm simply a trader that likes sharing a bit of what I know. Trade at your own risk. I hope you enjoyed the series. Hey, welcome to my 7th video in a series I'm calling Back to the Basics, where we'll work on covering all of the basic fundamentals needed to start trading futures. From beginning to end, I want these videos to be straight and to the point, focusing on all areas of knowledge needed to start taking trades and build that confidence within yourselves. In the last video, we specifically talked about how to count legs using price action in a moving futures market. Today, I want to talk about some basic price action rules that we can follow that will keep us on the right side of the market while also giving us somewhat of a better idea of where prices are most likely going to go. Now, do we ever know 100% where prices are going to go? No, but we can use these rules to kind of give us a better idea so that we can either get into some good trades or it keeps us out of some bad trades. So the first basic rule to remember is the trend is your friend. You don't want to trade against the trend. If you see the market is in a downtrend, we don't want to try looking for reasons to go long. We don't want to try picking bottoms. And what I mean by that, let's just say this market is moving down. And as we're counting along here, we're drawing our trend lines and whatnot. We get this new high here. Prices come down and up for a first entry long. As prices come down and up, you say, oh, we have a second entry long. I'm going to enter a second entry long, go against the trend, go for that one point that I'm looking for and make $50. So you'll enter this trade. The next bar will form, get you into that trade. Now you're going long. You're anticipating prices are going to go up. And as prices continue to fall down, you've now lost a lot of money. So don't try going long if the bias is short. As we're trading, there will almost always be a bias to the market. So if the bias is short, don't look for reasons to go long. Stay on the right side of the market. Stick with the trend. And inversely, if the market's going up and we see the market's in an uptrend, we want to look for reasons to go long. We don't want to try picking tops and shorting, anticipating for the market to go down. If the market's going up, we got to stick with it. Follow the market. And just an example here, let's just say prices are starting to kind of consolidate a little bit here. They're starting to find support here at the bottom. And now the trend is starting to change as 21.9 EMA are moving up. We're resetting the count here. Prices come up and down for a first entry short. Prices come up, down for a second entry short if there's a trigger below this bar. So you tell yourself, yeah, I'm going to take a short here. You enter this trade. Immediately that second entry short fails. Prices reverse and you get stopped out of that trade and you lose money. The point in me bringing this up is just because we get second entry shorts or second entry longs doesn't mean we should take them. We are not pattern day traders. We don't trade the patterns. We trade price action specifically. That with overall market context, we have to understand what the market is doing. We can't just be taking trades because patterns set up. It's got to fit with the overall market context. So the trend is your friend. The next thing I want to talk about is breaks and new extremes. So we talked about how we draw our channels, but now there are specific rules with these channels. So as prices move down, they're holding neatly in this channel. When we get a break of this channel, we're anticipating for prices to make a new low or a new extreme. If we're in an uptrend, for example, right here, we have a short-term trend working up and we get a break, we're anticipating for prices to make a new high or a new extreme. And you'll see that's kind of exactly what happens here. We have the short-term trend that's working up with the break looking for a new extreme, and that new extreme is a new high. Prices reach that new high. And what does that mean? That means this uptrend has played out. Now we're looking for prices to reverse, push down back below the EMA. And that's exactly what happens here. We have this channel that's moving down, short-term trend is drawn. We have a break of this short-term trend. Now we're looking for prices to reach and make a new low again. That's what we're anticipating for prices to do. And that's going to help keep us on the right side of the market and find solid trades. And you'll see prices, we're anticipating for them to reach a new low, and that's exactly where prices go. And this is done continuously. The same thing can be done with the short-term trends, right? We have the short-term trend that's working down with a break, looking for a new low, and that's what we get. And as prices continue to make new lows, we can expand these channels that we have to accommodate more of the price action. And I talk about these rules specifically in a lot of my previous videos. So if you really want to get accustomed and used to understanding these rules, watch my previous videos. Now that you've come this far in understanding some of the basics, those past videos will make a lot more sense to you. So prices continue to move down. We're trying to accommodate price action as much as we can. And we get a clean break here of this channel that's working down. So what are we anticipating? We're anticipating for prices to make a new low. Now, sometimes we won't always get that new low, but we could get an attempt at a new low. And that can give us a lot of information too. So as prices tried pushing down here, there wasn't enough strength to push the market down lower. So when prices come back up, you see this 21.9 EMA flattening out. This tells you, okay, we're in a bit of a trading range here, and that's what you want to start drawing. Now, the way I draw my trading ranges, I want to try and keep this 21.9 EMA. If they're flat, I like trying to keep that in the center of my trading range here. So I wouldn't even be opposed to maybe moving the support level of this trading range up a little bit to accommodate that price action. So we'll talk a little bit more about trading ranges in a bit, but once we get that break and new extreme or attempt at a new extreme, prices will either consolidate up and down or it'll lead up to a straight up reversal. So for this example over here, we have this channel that's moving up, break, new extreme, reversal. Prices reverse below the EMA. For this example here, prices are moving down, break, new extreme, continuation pattern. Prices just continue down. For this channel here, we have a break, attempt at a new extreme, and consolidation. So those are really the things that could happen. So let's continue on with our example a little bit here. We have prices that break below this trading range. So we want to try and incorporate this channel, right? As prices are moving, we get a break of this channel. What are we anticipating? We're anticipating for prices to make a new low. We're anticipating for prices to continue pushing down. So we're looking for reasons to sell. And as prices come down, we do get that new extreme and prices go exactly where we anticipate they're going to go. After we get this new extreme, what are we anticipating? Either consolidation or straight up reversal or a continuation pattern. But what do we get? Prices are stacking up and down. So very clear cut. Look at that. We're in a trading range. So this is where you start drawing trading range, trying to accommodate the highs and the lows, try and keep this 21.9 EMA in the center of these trading ranges. And I think I've temporarily mentioned it in other videos, but with trading ranges, the way we like to trade these are to buy when prices are low, and we want to sell and short when the prices are high. We'll look for a better example. This is a little bit of congestion, overlapping bars. We don't necessarily want to trade any of this. But if I do back up a second here, what we can find here is prices are oscillating up and down above the EMA, right? EMA is oscillating up and down as prices move to the highs of the range, then move down to the lows of the range. They're finding a level of support down here. They're finding a level of resistance up here. You can see as prices come up, it finds this ceiling. It finds this level of resistance that was previously found over here. Look at this double top, single top, double top right here. It establishes that level of resistance and prices come back to find that level of resistance up here. So in these trading ranges, we want to sell when the prices are up here and we want to buy when the prices are down here. Now I could really make a whole separate video on trading ranges, but just as the market has a general bias throughout the day, so do trading ranges. When we trade down into this trading range, we're most likely to trade down and out of this trading range. And that's pretty much what happens as prices trade down and out. If we traded up into the trading range, we're most likely to trade up and out of the trading range. So because we traded down into this trading range and with the way price action is moving, there is a bearish bias here. We'd really tend to try and look for shorts in this trading range. So we want to look for shorts up at the top of this resistance. Now if I were to slide over for a second, some people may argue we could have somewhat of a trading range somewhere here. So this is an example where we traded up into this trading range as prices find the lows, find the highs, back to the lows, and then breaks out the top. Now with channels and trends, we have overshoots. So that's where prices will push a little bit farther than they're supposed to on the bottom, a little farther than they're supposed to on the top. And what I find happens is that these overshoots generally lead to a generation of momentum. So as we get an overshoot to the bottom side, that's going to generate momentum to shoot it out the top side. And as prices move up, this overshoot should generate momentum to push it back down. But because we're in a bullish uptrend, because we have that bullish bias, there's not enough pressure to push prices down. So when prices hold here at the bottom of this support, we're anticipating for prices to push up and out of this trading range. So we're looking for reasons to go long. And that's what we see happen as prices continue to push up here. Now let's continue on with some of these examples of these short-term trends. We can still draw them in trading ranges. We have the short-term trend that's moving up with a break move to a new high. So this uptrend has played out. But as we see prices come back to test the 21 EMA is holding. So we really have a bigger uptrend at play and we want to try and incorporate price action here. But this is going to be a perfect time to say be very careful about drawing bigger channels in a trading range. What I've found is in trading ranges, really stick to short-term trends, try not to extend too much because Because prices are moving up and down so rapidly in these trading ranges. We have this channel that's moving down with a break, move to a new low. Prices come up and down again, establishing that level of support. So this downtrend has played out. We're anticipating for prices to push back up and find the top level of this trading range. And that's exactly what happens as prices continue up, finds that level of resistance and eventually breaks through the top and continues on. Let's find some more examples here. We have this short-term trend that's moving, break, move to a new high. Once we have that break and new extreme, prices will either consolidate, give us a reversal, or some sort of continuation pattern. Let's see, we have a short-term trend that's here. Short-term trend with a break, move to a new low. So this downtrend has played out. We're looking for prices to continue up. Prices kind of moving up and down here in somewhat of a trading range. Very small, but it's there. Then prices shoot up and out. As prices come down here, we have a bit of a short-term trend here with a break, move to a new low. As we continue to get new lows, we have a bigger channel at play. Prices break, attempt a new low, find a level of support, right? This is what we're looking at. This downtrend has played out. We attempted that new extreme. Now prices are reversing, pushing back above the EMA. I already had this short-term trend line drawn with a break, looking for a new high. Now when we're moving in an uptrend, we'll have moments of correction here, right? As prices move down, we have this moment of correction. Prices give us a slight break, move to a new low. Now this downtrend has played out. The correction has played out. Prices are going to continue up. And that's what we get. And as prices come back down again, there's a moment of correction. Draw that short-term trend, a little bit of correction with a break. We either get that new low, there's that attempt at a new low, really is a higher low as prices continue up, continuation pattern. We really want to just try and draw these consistently. Very short-term trend with the break. Prices don't really push low though, they continue up. But as you draw these, they're very minor, right? You draw these very minor moments in correction. What you'll find is when we draw the bigger channel that's at play, actually it might be a little bit hard to find here, but as we draw this bigger channel in this uptrend, we have moments of correction, these pullbacks to this 21 EMA, this level of support. And as prices continue up and we draw this bigger channel, it looks like a ladder just moving up, you know. But eventually that ladder will break. We have this channel that's moving down and we get a break looking for a potential new low, but we don't get that. Prices are kind of holding here at 21 EMA. They're continuing up. Short-term trend with a break looking for a new high. Now, I should have mentioned it before, but look what happens. We have this big uptrend at play, break of this big uptrend looking for a new high, and that's what we get. So very important to recognize stuff like that. Break looking for a new high for this bigger uptrend. As prices are working up, we have this short-term trend that's working up with a break looking for a new high of this short-term trend, and prices go exactly where we think they're going to go. They're just going to go up. And as prices oscillate up and down, which we established a little bit earlier, you know, we draw this trading range at play. But those are a few of the basic price action rules that we can use in order to take trades. And so continue to practice. You know, you can just open up a chart. It doesn't have to be live. Practice drawing short-term trend with a break. Where do we anticipate prices are going to go? New low, this new extreme. And prices push down, barely make a new low. This downtrend has played out, leads to a little bit of a trading range before prices continue to push down. Just get comfortable drawing stuff like this and analyzing the market. Learn to read the market in that way. And those basic price action rules will help keep you on the right side of the market. I highly encourage you to go watch some of my previous videos. Things will really start to make sense and hopefully give you a better grasp on where you should be looking to take trades. It all comes with experience. Continue to take the time to learn it. If you're passionate about this stuff, it makes it that much more fun and enjoyable. If you like today's video, please leave a like, subscribe to the channel, turn on post notifications so you know exactly when I post this content, and leave a comment. Let me know what you thought about today's video and what you think about the series. I appreciate any and all feedback. Strive for excellence in all that you do, and until next time, thanks for watching.